Juliana Rodley there from CommSec. Let's move away from that story and take you into fixed income. Stephen Nash from Fig Securities joining me in the studio. Stephen, I guess really a reaction first off, if you could, to what happened just hours ago around that table at the Fed. Still markets are digesting it, but you look at the yield curve and you wonder whether bond markets have actually got this way.
Well,
steepening of the yield curve.
Well, in effect, there's two markets here. There's the long 30-year market, and then there's the rest of the shorter part of the market. Now, the 30-year bond hasn't been reacting to QE2, and the reaction overnight was, again, not positive.
Because isn't that the market, the very one that the Fed would have been targeting, like it did the first time round, to bring down those longer-dated mortgages?
I think the 30-year rate is really important for the Fed.
You saw all the movement in the 5-year.
5s and 10s.
Yeah.
There was a little bit of disappointment about the amount that was purchased in the 30-year area. I think there may be adjustments to that over time in order to bring that 30-year down. Yeah, as you say, it's really important for the mortgage market, and to stimulate borrowing, we need that 30-year a lot lower, I think, yeah.
That's the thing, the next step as well, which will be take-up, because it's all very well for banks to take on this excess liquidity, if you can call it that, which it clearly is, but it's now then the paying it out. If you don't actually have demand, you're stuck with it.
Well, Martin Feldstein in the FT yesterday was going on about, he's worried about this policy is classifying it as risky, and he's worried about money going into the banks and just becoming stale. I think the Fed really has to concentrate on getting that money out. An example might be, you had a fixed rate mortgage and you had an 80% LVR. As you know, property prices haven't gone up, they're gone down. So your LVR is not going to be in a pretty state. So how do you take advantage of that lower rate? Problems like that and others need to be solved, I think.
And then how do you get a sort of an equilibrium on the market? How do you even judge what companies are worth in this environment when they're sort of so beholden to hot money? It's a very difficult one to square.
Well, since the Jackson Hole speech, equities, as you know, have gone up around 10%. Some people are saying that this is the QE2 is all about asset prices and not really about the economy. I think it's partly about the reflation story, but we've got a big time period between that reflation actually occurring and now. So I think people are getting a bit ahead of themselves in a sense, and equities and the 30-year bond are already there. And what I'm saying is that probably need to correct a little bit. Yields and 30 years need to come down and equities need to correct, because the reflation is just not going to be immediate.
What story timeline are we talking then, realistically? I mean, because the Fed left the door kind of open. It didn't close it, in fairness. It said, you know, we'll monitor and may have to come back for a QE3.
Well, there is also, I suppose, some disappointment in the sense that the outlook wasn't changed. It wasn't more dovish, and that they don't that need to be implemented, and I think,
well, one of those debates that's now sort of being fought is gridlock good or bad? Is doing nothing, is actually standing still not a bad policy, because it does it.
Act, the Dodd-Frank Act is really the new operating system for the entire US economy. And there's a lot of really good things in that piece of legislation.
That's not going to clear the debt, though, is it? Delaying Dodd-Frank is not going to clear your balance sheet.
No.
What will clear your balance sheet in the US?
Well, in terms of the US deficit, I think that's a bit of as well.
Does it all come down to a failure to sell a product successfully? That is to say, sound bites and slogans to mask, if anything, still a reliance on union might within a party. This is the problem, arguably, with the Obama administration. That's that bloc exerting too much influence. To break that, though, you almost have to go the way of a GM, which you can then actually positively tell the public about. Look, it's floating. Look, it's changed its ways, because we got in there with a 43% stake.
Yep.
And now we're getting the payback. So you could do more stimulus like that.
I think you've got to change the way businesses operate in the US. I agree with that. And you've got to change. I think also on the agenda will be the currency, as I've been saying a few times. I think that the G20 will be very important for that.
He goes into that meeting, Obama, surely, with less clout, with less right to sort of sit at the top table and call the shots.
Well, I think he's got 2 years to really perform now, and I think he's going to go for it in a lot of ways. And the economy is the #1 policy on the agenda, is particularly the unemployment rate. He's got to get that down, and currency may be one of those instruments, I think.
They've spoken already, though, of the shift as of last night into campaign mode for the next president. It's a bit like us in that last year before an election. What's done? Everyone's just chasing the votes. That's not a recipe for clearing the decks of deficit.
Well, I think he's got to get some runs on the board in terms of the economy, and I mean, there's been a lot of promises, as you say, a lot of spin. We've got to get some runs on the board for the economy, and I think, setting the sails for growth and clearing the decks, basically delaying a lot of other policy initiatives and focusing on growth. I think that's what they're going to be doing.
Stephen Nash, appreciate you coming in. See you next time.
Okay, thank you.
Stephen Nash there from FIG Security.